Hello and welcome to the video on bookkeeping controls. This is an introduction in chapter 1 and it's to the AAT level 2 bookkeeping controls tutorial book. What I'm going to do is I'm going to provide basically a bit of a talk through on each of the chapters within this book. And that's going to help you use this before your lessons so that you can have a look through, or you can have a listen to this, have a read of the book as well at the same time. And then when you're turning up to your lessons, this should allow you to be asking questions, have a more of an understanding, and really get it to a more effect. So this will really improve your learning. When I was training, I would look and read the books before I turned up to class, and that really helped me quite a lot. It'll also as well give you a bit of a revision that you can always come back to. You've got the books, but the books, what actually is happening here. So that's what I'm going to do within these videos. I'm going to explain what's going on a bit more and give you more detail. So before I go into any of the chapters on the bookkeeping controls, I'm going to give you an overall view of why these bookkeeping controls exist and what is it that the professional accountant is doing. Because when somebody looks at these systems in place, you might think that there's a lot of work going on that's quite duplicated. It seems quite complex, and it seems like there's a lot of effort for no gain. And there's some things that are going on that are being put in place that are there to design to protect the financial integrity really of the system. So I'm going to take you through the accounting principles that the professional accountant that will have set up the finance system that everybody in the finance department will be following has considered. And the first one is accuracy. And they've had a think about their system, and they have a view that things have to be put into place to be accurate. They want to get the numbers right. They want to be paying the right people. They want people to be doing the right things as well. So they might want to prevent certain actions to try and make that accurate. So they will set up the controls and the approach to act as a backstop to that. I'm going to take you through another principle later on, which will also explain why. They're going to look at relevance as well, and this won't be as important as accuracy in bookkeeping controls, but relevance still will be important to understand certain things. So, for example, the debtor, the customer's position, or the supplier's position. How long will they expect to have in terms of when they have to pay? How long do we have to pay? That kind of thing, make this relevant. So we'll try and improve that and make it easier then to make decisions. In terms of timeliness, we've got to produce a lot of data in terms of our accounting system. So we're going to try and set out our controls in a way that actually this will produce an accurate, relevant position in a quick way, or in an efficient way. It won't be the quickest way, because there will be other things that are required, but it will be in a timely way, and we'll get our information on time. We have to keep this in our head. And then the last one, in terms of the 4 accounting principles that we're going to use for data, is this idea of comparability. That I want to be able to compare data, one number to another number, and get an idea about either accuracy or relevance. In terms of accuracy, is this figure right? Is it relevant? Is it what I expected it to be? So I'm going to have a look at this idea of comparability. Now, what's this other principle that I was talking about? And this is the principle of the professional accountant, and that they're professionally skeptical at all times. They think that things will go wrong. There will be errors. People will make mistakes. They will. Either within your finance team or within other finance teams. So we're always thinking that there will be errors at some points. And so what we're going to try and do is set up our systems to prevent errors, hopefully, but also as well, when errors occur, to be able to find them quickly and correct them quickly, and also correct them in a controlled manner. So we have this professionally skeptical position that people are naturally human and therefore will make errors. We also have this idea of professional skepticism in terms of people who may be dishonest, and that might happen and create a situation whereby either people within our own firm or people within other companies might adopt either a dishonourable or a dishonest position. Somebody might not pay us, somebody might pay us late, somebody might run off to the Bahamas with our money. And so what we're going to try and do is create a set of controls in place that will hopefully prevent it, or certainly, if it happens, find it quickly enough that it doesn't cause significant damage. And so often students can't quite understand this. If let's say we went back to the bookkeeping transactions sort of section, why is it in the five-stage accountancy system we had all of these various different books and these various different ledgers? Well, it was to be able to split up the accounting system into various people, so that nobody, unless they colluded, a whole series of people colluded together, nobody could actually commit a successful fraud because somebody else would find it quickly. So we've got those ideas going on, and I want to just take you through those before we went into the books, because it's useful to have those words alongside as you're going through, because you can then see why it is that a certain system has been set up in a particular way. Okay, so what we're going to do first then, in chapter 1, we're now in the idea of what are the payment methods available. Now, chapters 1 and 2 of the book are setting up something in chapter 3 called the bank reconciliation. And the bank reconciliation in chapter 3 is a really important thing within finance systems, where we have the bank statement, and that comes from the bank and is a very robust piece of evidence that we then are going to compare to the cash book, what we think our cash position is. And by comparing them, we're going to see whether we're right, whether we're accurate, whether we're accurate, and also as well whether where there's an honest position as well provided. Being able to do that comparison between those two pieces of information, that then is really going to create a lot of robustness and sort of solidity about whether our figures are correct. So chapters 1 and 2 of the book set up chapter 3, bank reconciliations. So in chapter 1, we're going to go through the different methods of payment that a company could make, and what are the advantages and disadvantages of them, and also then in chapter 2 we're going to go through the timing of those. That then is going to set up chapter 3. So what are the potential methods of payment that a company could make, either to their suppliers or their customers could make to the company? So we've got the first one, which is cash. Sometimes called petty cash, sometimes that people might call it a petty cash system or an imprest system. If we're in a company, this would be a petty cash tin, with some money inside, and somebody would be running a system there to work out how much petty cash would be in there. The advantages of cash is that it's immediate, it's there, the payments straight away. It can be very convenient for customers. And it can be very sort of convenient as well for a business if it's small amounts, to not have to run a whole series of expenses claims. There's a disadvantage for cash. If we are taking cash from customers, we've got to go and bank that cash. It's got the potential for theft. In terms of, there's also the time to go and bank it. So we have to have two people count up the money. To make sure that one person doesn't go and decide to skim a bit off the top. We then have to go along to the bank. Usually we have to have two people going along to the bank, one to protect the other one. In there, there's a lot of time to get that cash into the bank. There's also the potential then for theft, either it's been stolen if it's in a safe that we had to keep overnight, or there's a potential for theft if we're stolen from us on the way to the bank. There's also the potential as well in terms of cash for other dishonest practices such as money laundering. So let's say we were in a situation whereby I am selling high-end luxury cars. So I've got a Ferrari and I'm selling it for £70,000, and somebody walks into my garage with £70,000 worth of cash. I would have to be considering, wouldn't I, where their funds had come from, as who walks around with £70,000 worth of cash. So there'd be a lot of additional work that would have to be done in that system to consider whether I could actually take this cash, or would I be furthering somebody's proceeds of crime and allowing them to profit from crime by doing that. So cash has a certain level of limits attached to it, a cost to be able to operate, but it also has a level of convenience for the customer typically, and a level of convenience for the business, and in small levels. Cheques then is not cash. It is basically a paper version, which is a transfer between bank accounts. It can be difficult to steal because the cheques are typically written to pay the payer only. So don't pay anybody else if this is stolen. So effectively it becomes worthless to somebody else. It can be posted with something else, like say a remittance advice or a letter or something along attached with it. So it can go through the post, and it's not like cash going through the post where there's a real risk attached to it. If somebody steals a cheque, there's not much they can do with it. I'm putting here the potential for the cheque not to be cashed. Now this is a slightly dubious practice. But let's say that I was an insurance company and part of my offer was that you take out insurance with us and we will give you £50 cash back. And I do that to 1,000 customers, and I send out £50,000 worth of cheques. There will be a good £500 worth that will not be cashed by the customers. They will forget about their cashback offer. The cheques will be lost, or they'll be fallen down the back of the cabinet or something like that, or lost in the post, and I will save some money that way. A little bit dubious, one has to say, but is the reality of life. And we'll see later on this thing of cheques not cashed, that you can actually have cheques not cashed in the system. Now there's some disadvantages to cheques, and the key disadvantage to cheques is that they are very costly to generate. If you imagine that you have to write them out by hand, that's a lot of time for somebody to do that. Or alternatively, there's electronic. You can print cheques by electronic printing. So we're going to send all of our suppliers cheques for their money. We've got to print those cheques. Whether they've been printed or written out by hand, they've got to be put in an envelope. We've got to seal the envelope. We've got to frank or put a stamp on the envelope. We've got to go to and post it somehow. That's a lot of time just to send out the cheque. If we receive the cheque, we have to bank it, and that's going to take time as well. We've got to have somebody to open the post. Typically we would have maybe a couple of people opening the post because of the potential of cheques coming through, opening the post together. Then we've got to go and write up these cheques into our cash book. We've then got to go along to the bank and take these cheques with us, and we've got to write up and put them in. So there's a lot of time involved in that. It's expensive. Now I've put this down as a disadvantage in the cheques process, that it applies a delay to the payment process. So it will take quite a while for cheques to both be processed and to then actually hit the bank account, to clear the bank account. That's what it's called. Now this delay I'm saying is a disadvantage for us as the receiver of a cheque. Of course, it can be a bit of an advantage that if you don't want to pay earlier, and if you want to sort of delay the payment coming out of your bank account, you could use cheques, and you could pay by cheques to slow up the process, and it looks like you're making an effort to pay your supplier. However, in reality, you're taking a very long-winded approach to paying them. So those are cheques. We've now got debit cards. Now we all have those. We go and pay for things. They're very convenient for customers, and effectively it's a transfer from one bank account to another. In terms of the delay, it's very short. It will clear our bank account in the following day. So we've had a debit card and we've sold something via debit card. In the following day, it will hit our bank account. Are there any disadvantages? Well, there's a fixed asset cost to setting up a debit card system. So we would have to have the card reader and the till and the bank account all working. There'll be some software alongside that. That will have a cost. So if we were a very small business and we didn't have a huge amount of income going through, we might not like that level of cost impacting on our business. There is the potential for card fraud if the card is stolen, especially with contactless payments up to £30. That there is the potential there, but people can stop that. I think the customer convenience, obviously, as we'll see, heavy movement over to debit cards instead of cash, and certainly cheques are quite rare nowadays. So we have those as our advantages and disadvantages, and the key thing here is the 1 day delay in the receipt of funds for ourselves. So we might have put the till receipts in the cash book on the night, but actually it won't be appearing in the bank statement until the following day. Now, credit cards, we have here, I said customer convenience, but it can also as well at the same time be convenience for the business as well. So let's say we have somebody going along for a hotel and they've got to pay for their hotels and their food while they're away. They are a salesperson for us. They can take a credit card and they could go and pay for that amount, and that would be accepted by the hotel, and can be useful as a way in which that company can use and pay for the person's expenses without that person having to make an expense claim. There's a 1 day delay in receipt of funds. We receive them the following day. If we're receiving, we can actually get credit as well, which is useful. So we get credit from our credit card. So let's say we've made some payments on the credit card. There will be a credit card statement that will come in sometime in the next month. So it's really credit for the customer up to a month, depending upon when the payments are made, and that gives us some credit there. If we're looking and thinking that we need to create some credit and be able to pay for things, and we can't get, let's say, a long-term loan, we could use credit cards as a method of paying things and buying things. However, the disadvantages there, if we don't settle our credit cards, we have very high interest rates being applied. They're very expensive from an interest rate point of view. And also as well, credit cards aren't free to the supplier. If the supplier takes a payment on a credit card, that credit that's offered to that customer, plus all of the transaction cost goes alongside it, is charged to the supplier. And how that's charged is as a 5% charge, sometimes between 3 and 5%, on the credit card to the supplier. Now, if you're in an industry where credit cards are the use of credit cards are the norm, so we're in a hotel or we're in a restaurant, or we're on a high street retailer, that's the norm, and that's factored into the price. If we're, let's say, not in that situation, so let's say we want to go and buy £10,000 worth of computers, and we go along to our computer supplier and we say we'd like to pay by a credit card. That hasn't been factored into the price, and so the supplier is more than likely to say, well, actually, I'm going to apply an additional charge for the use of that credit card. And sometimes as well, you'll see in firms as well, they'll accept credit cards, but they'll apply a charge for their use. And they're not supposed to, but they do. So you need to keep that in mind, that there is a transaction charge applied to credit cards. Now, charge cards are effectively a credit card. It's for a business and it doesn't have the credit attached. So when the statement comes through, the business has to settle the credit card. Often these can be, let's say, agreements with individual suppliers. So let's say I run a haulage firm and I have all of my drivers going around and they are buying petrol, and I decide that we're going to have a Shell garage charge card. So all of my drivers have this, so they can make all of their purchases for petrol, and it means that it doesn't have to go through the finance department, so it can be cheaper and more effective than them all making expense claims. It's not got the credit attached to it, so it's cheaper in terms of the transaction fees. And so there's none of the 5% charges being applied. But there are some disadvantages to charge cards, and there's some disadvantages to credit cards as well at the same time. On the one hand, they need to be reconciled. So charge cards especially, if let's say we've got some kind of procurement card and a department might have this, and they're buying some stationery and they bought some books and they've also bought some materials as well. I don't know, some copper pipe because they're plumbers, and they've gone and bought a course as well online that they needed to go to, and then they booked something for a hotel as well. These are lots of different transactions that we want to know what those individual expenses are, so they would need to be reconciled by the department, who might not do that without some cajoling. So we need to set up our systems to be able to achieve that. Also as well, by handing over a credit card or a charge card to somebody, that means that they can go and make expenses that would be disallowed if they made an expenses claim. So for example, if this salesperson had bought alcohol with their meal, most often the firms would not allow that and would not pay for that expense. It's not tax deductible, and so the person would have to pay for that themselves. However, if they've done it via a charge card or an expenses card, you wouldn't see that unless you actually got the bill and read through it. So it can be quite expensive to reconcile up charge cards and credit cards. It also as well increases, and we're going back to professional skepticism here, increases the chances of fraud, because effectively you've put a lot of cash in the pocket of one of your employees, and they might go and start spending it on various things for their own personal life, and not really, and do things dishonestly. So if we hand over a charge card or credit card, we're going to spend a lot of time as well reconciling what is being spent, because otherwise we will be opening up the possibility of fraud. So now we're going to transactions that are transfers between bank accounts. So we've now got BACS. So BACS is an inter-bank transfer system. And what we do is, the disadvantage of BACS, which I'll go through first, is we have to set up the BACS notice 3 days in advance. So you have to get this 3 days in advance. So let's say I'm doing BACS payments for my payroll. And so I'm going to pay all of my employees. I'm not going to give them cash in a little envelope. I'm not going to give them a cheque to go and take to the bank. I'm going to actually pay them in a transfer to their bank account. I have to set up the payroll 3 days in advance. So let's say I'm paying on the last Friday of the month. I then have to be doing this 3 days in advance of that last Friday to be able to have the payment made on that day. When does this transfer happen? Well, it happens immediately on the day. So BACS transfers to us are really useful. They're on the day that the BACS instruction triggers, 3 days after it's made. And it's really useful for the employee, let's say, if we're making payments, or whoever we're making the payments to, that they know when they're going to be paid. The disadvantage is that 3 days notice means that we have to get it right, and if we don't, then we have to start cancelling BACS runs and then issuing via a different method. We now have a method called faster payments. Oh, I will go back to that idea as well of BACS payments and getting it wrong. If we get it wrong, in a cheque, there is an advantage in a cheque. With that time that it takes to delay in the payment process, we could cancel the cheque. So let's say we got a payment wrong and we put a 0 in the wrong place, and instead of writing out a cheque for £1,000, you wrote out a cheque for £10,000, and we've posted it by accident, but we have in the little cheque stub £10,000. So we've noticed that we've actually got this wrong. We could cancel the cheque, so we could get that back. In the backs payment, well, we've cancelled it, but now we've got to go and work out how to do it, or alternatively we forget and we don't actually look at the instruction and we get it wrong. So they'll often within backs there will be a series of checks as well, and we'll see what's known as the wages control account later on, which will be checking backs runs. Faster payments is like backs. It actually uses the same system, but what it is it's the same day without the 3 days notice, and it doesn't have any fee, and neither does backs. Backs doesn't have any transaction fee either. But faster payments does have a limit, and its limit is typically £10,000. Sorry, £100,000 is the typical limit on faster payments. That you can't make a huge payment via faster payments on the day. You have to use a different system, and a different system would be CHAPS later on. So we've got our backs and we've got our faster payments, and so these are transfers between bank accounts. Now we've got some things which will be types of backs and faster payments. So something which we call the standing order. So we've set that up, and this is going to be a set payment for each period of time. So I've decided that I'm going to buy a computer on hire purchase. I'm going to make 36 payments of £40 a month. To do that, I set up a standing order. It will use the backs or faster payments method. It'll be for a preset time or until it's cancelled. So that would be one way. Probably use faster payments rather than backs, because it's just got that doesn't have that delay time in the instructions. Direct debits is also for a fixed payment, but typically for variable payments set up in advance. So this would be where I have agreed with my electricity supplier to pay via direct debit. Just take the amount out of my account. The payment changes each quarter or each month, and it uses the back system, and it allows for variable payments to be set up in advance. But of course, now I've given somebody access to my bank account to take out whatever they actually want to. So it's variable payments, and they'll require checking, and there's no control over what's been withdrawn. So there is the potential for them to make mistakes. And so every so often you'll see in the paper somebody having £1 million withdrawn from their bank account in error. So that's standing orders, which is fixed, and direct debits, which is typically variable. And using the back system for direct debits, using backs or faster payments, typically faster payments for standing orders. We have mobile phone payments as well, which is really the faster payments just in the mobile phone app. So if you asked them that. So those are backs and faster payments, and different methods or names for backs and faster payments. Then we have this different thing called CHAPS. Now it operates in the same way as a backs or faster payments. It's a transfer between bank accounts, but it has a fee attached. So why does somebody use CHAPS with this fee attached rather than using simply backs or faster payments? Well, CHAPS doesn't have a limit. It doesn't have the £100,000 limit as faster payments. So that's the reason why if you went over 100,000, you'd be using CHAPS in any case. But also as well, CHAPS has an advantage. Faster payments will take 2 hours to clear and can be cancelled in that time. Backs has 3 days to set up and can be cancelled in 3 days. CHAPS cannot be cancelled once set, and it's the same day period and same day payment and no notice required. So what is the advantage of this cannot be cancelled once set or once sent? And the reason why is because within UK law and any contract, they can't be cancelled except one, which is for land payments. Land payments can be land transactions, so for land and buildings, any transaction for those can be cancelled at any point, and there's no comeback on the person who cancels the transaction. So if one was trying to sell your house and you're in a chain of suppliers, and we decided to do this via faster payments, and in the 2-hour period between one person selling their house and deciding to buy another one, that person who was selling the other house decided to have a change of heart and said, actually I'm really attached to my house, let's just cancel the whole deal. They would break the chain, and the person who'd already sold their house in the other faster payments amount would now be homeless. So CHAPS is used in land and building transactions in order to be able to protect the transaction and the whole chain. It's also as well there that people cannot pull out in the gap that is there in faster payments, that 2-hour gap. Faster payments has a limit on it in any case of £100,000, whereas CHAPS has no limit. So if it's over £100,000 or if it's land and buildings, you'll see CHAPS being used rather than faster payments. Now we're back to something that looks like a cheque, which is a bank draft, but this is a cheque written out by the bank. It's not a cheque written out by either an individual or a company. And because it's written out by a bank, a big disadvantage of cheques is that cheques can bounce. There might not be the money in the account, and as a consequence the bank might not pay on a personal cheque or a business cheque. It might say there's not enough money, your cheque is worthless. A bank draft is a cheque that cannot bounce, so the bank will pay it because it does have a value and the bank doesn't run out of money. So it effectively is cash in paper money, in paper form. So it's got that advantage that you can move around with this, and it's not like carrying a big bag of cash that can be more easily stolen. However, it can still be stolen. And also as well, is it really genuine? So how many people really see a bank draft, and how many are they really genuine? So typically you would be having these things for the sale of cars, let's say, in there if you're doing either a private sale of a car or we're deciding to buy a whole series of cars. We'd have a bank draft that would be done. The other person would often bank the bank draft first. They wouldn't hand over the car before banking it, really, because it might not be genuine, and then that would be handed over. But bank draft is effectively a cheque written out by the bank. It's effectively a cash in paper form, but a big figure in there via the bank. So it's not a question of I've got this money laundering issue that I'm in a luxury garage providing this Ferrari for £70,000 and worrying about whether this other person's a criminal. The bank's already done that check for me because they checked where these funds have come from, this £70,000, and so I don't have to worry about the money laundering aspect of this bank draft, unless I was aware that this person was somehow stealing from a company, let's say, that had been set up. So those are our different payment methods, and those are the time periods. And now what we're going to do is we're going to do some questions. We're going to have a look through what the questions are. So if you look at page 14 and 15, we're going to have a look at this. So question number 1, cash is most likely to be used as a means of payment by a business in which two of the following situations apply. Small items of office expenditure. Well, it's small items, so those sound a good point for cash. The wages of an employee who has a bank account. That doesn't sound like a good idea for cash. That would be more of a, let's say, a cheque, or more of a backs thing. I'd use backs personally. Well, typically it will be backs that will be used there, so it won't be B. The wages of an employee who does not have a bank account. Well, they can't be paid by a cheque, and they can't be paid by backs, so they would have to be paid by cash. Been phased out a lot now, really. You very, very rarely see somebody being paid their wages via in cash now. So 1.2, a cheque is a written instruction by a customer to the bank to pay a specific amount of money to a named person or business. So named person or business, that sounds like a cheque. A written instruction, yes, to a bank to pay a specific amount of money. That's a cheque. Let's go for B, a written instruction to a named person or business stating that they will pay a specific amount of money by a specific date. Not really, although actually I don't think that's going to be the answer. I'll go and just check that, because on a cheque it does have the date, and so you could do a post-dated cheque sometimes, is what you'll see, but I don't think that isn't the answer. Yes. And C, a written instruction, and it isn't B, a written instruction by a customer to the bank to pay a specific amount of money on a specific date. Well, it doesn't have a named person in there, so it's not a cheque. That would be a very old method before they became accounts, what's known as accounts payee only. You see little crosses across a cheque which says just pay the person in the account, so it definitely isn't C. Which one of those are correct? Well, it has to be A then, because that would be the one that would be there. Let's go 1.3. A debit card has the following features: true or false, columns as appropriate. It allows businesses to pay for a number of purchases in one amount at the end of the month. That would be a credit card, if you remember, so that would be false. It always requires a PIN number entered on the terminal when it's made. Not anymore. They used to be, but now we have contactless for up to £30. So it's not B. It cannot be used to make payments online. It can. You can enter in the numbers to make payments online, so a debit card can be used to do that. The payment is taken from the bank account of the card holder. Yes, it is. So it would be true. So that one is the only one that is true, and that one is D. 1.4. A credit card is a useful form of payment for a business because it's a secure way of making very large payments. It's not a secure way of making very large payments because, as we've sort of seen, we don't make large payments using credit cards because we have high transaction fees. No interest is ever charged on the amount outstanding on the card. That's not true. If we don't pay it off, then we get very high interest rates being charged. It can be used by a sales rep who travels around for business and has to pay for expenses incurred in her job. That would be true. That would be the purpose of using credit cards. It allows the person who we've given the card to make those payments without having to go through the finance system and not having to go, well, actually having gone to our finance department and not having to make expenses claims. Which one is true? And that's C. Standing orders are best used for payments which are equal in amount. Well, they are going to be equal in amount, so A would be true. Are variable in amount? No, that would be direct debits. So direct debits would be a variable in amount. Are made on different dates in the month? No, they would be on the same date. They are a set payment at each for a set periods. So they are set payment at specific dates. So it would be A, would be equal in amount for standing orders. 1.6. You are running a business and need to make various payments each month. Which method of payment in the list below would you use? Enter the number. Well, let's have a look. Paying variable amounts to 20 suppliers at the end of each month. I'm going to go backs there. Let's have a check on that one. Number 6, backs. Yes, backs direct credit. So I've gone for backs there. It's always comforting to know that I get the answer right. Paying a monthly rates bill of 12 instalments of £258.90. I'm going to go standing order there because it's a fixed amount and it's in fixed periods of time, so that would be fine. Buying a new car for costing £34,000 for delivery in the following day. Well, I've already sort of inclined that bank drafts are about cars, really, and vehicles. So I'm going to go bank draft there. I've gone and taken that because I've got a method to go and do that. You can sometimes go to the bank and use faster payments there if you're a person doing that, and so you could do that. But I don't think that faster payments is on the list. It's not, so we're going to put bank draft in there anyway because we've got to get them. We can use all 6. Paying an electricity bill which has variable quarterly payments. So as I've already said, direct debits were about electricity bills typically, and various things that have variable amounts. So we're going to be direct debiting there. Buying a jar of coffee for office use from the local food store. Well, I'm going to say that's going to be petty cash probably. Well, let's have a look. Is that on the list? Cash which you can claim back from the person who operates the petty cash system. So yep, petty cash there. So we go and buy that jar of coffee for cash and we claim it back in petty cash. The same day payment of £350 to a firm of solicitors for the purchase of a new shop. So we're going to be CHAPS here, and we've got 2 reasons, right? Yep, CHAPS is on the list, number 5.
And they've got two reasons. It's over £100,000, so we're going to be we can't use faster payments in any case, even if we wanted to. And we're making a land purchase, or a building purchase, so that's going to be 300. That's going to be using CHAPS in any case. So those are the answers there for 1.6. And I think that is the question. Let's just have a little check whether I got them right. I did. Yep. Okay. Good luck with your lesson. Hope you enjoy it. Thanks a lot, and I'll see you soon in chapter 2.